The Bureau of Labor Statistics released the April inflation number this morning at 8:30. It came in at actual CPI percent. If you were watching this within a few hours of that release, you are standing at exactly the same moment in the inflation cycle that American households stood at 4 previous times in the last 80 years. The moment when the number crosses the threshold that history says is not the destination, it is the launch pad. Actual CPI percent is not the danger. What has followed actual CPI percent during wartime in every documented historical instance since 1942 is the danger. And the historical record is precise. Every time the United States Consumer Price Index hit this level during a war, the next 12 months produced an outcome for savings accounts, home values, and gold that almost nobody predicted and almost everybody remembers differently than it actually happened. Dorothy Vasquez is 58 years old. She is the assistant superintendent of curriculum for a mid-sized school district in Albuquerque, New Mexico. She has a defined benefit pension coming in 7 years. She has $43,000 in a high-yield savings account, a home she bought in 2011 with a 30-year fixed-rate mortgage she will finish paying in 2041, and approximately $9,000 in a gold ETF she bought on the advice of a podcast in 2022. She read the morning's CPI number at breakfast. She does not know whether to be relieved, worried, or both. She is asking the same question every person in her situation is asking today. What does this number mean for my savings, my house, and my gold? History has an answer. It is not the answer you will hear on television this morning. My name is Ben. I have been building a 4-row scoreboard across 8 months of research using the Bureau of Labor Statistics historical CPI tables, the Federal Reserve's FRED database, the only gold annual historical closing price series, the National Bureau of Economic Research working papers on wartime housing markets, Regulation Q rate ceiling records from the FDIC, and the Federal Reserve history essays on the 1942 yield peg and the 1951 Treasury Federal Reserve Accord. The scoreboard has 4 rows and 3 columns. The rows are the 4 previous times in the last 80 years that the CPI hit the current level during a wartime period: 1942, 1951, 1974, and 1979 through 1980. The columns are the 3 assets Dorothy holds: savings deposits, her home, and gold. Each cell in the scoreboard shows what actually happened to that asset in the 12 months that followed each inflection point. I'm going to walk you through every cell. By the end of this video, you will know exactly what the historical record says about the next 12 months are likely to look like for each of Dorothy's 3 assets, the 2 numbers to watch instead of the daily headline number, and the 3 specific actions the record supports. Subscribe to the channel before we continue and hit like. Share this video with anyone who woke up this morning and asked what the CPI print means for their money. The scoreboard exists. The data is public. The pattern is documented. The information just has not been assembled in one place for the audience that needs it most. Row 1. 1942. The United States entered World War II in December 1941. CPI inflation at the time of entry was approximately 3.3% and rising sharply. By mid-1942, headline inflation hit the approximate level of the current reading. The trajectory was not ambiguous. The war had created massive supply disruptions, labor shortages in civilian production, and government demand for materials that competed directly with consumer goods. The federal government imposed wage and price controls in April 1942 to suppress the measured inflation rate. The controls worked, partially. Measured CPI was held in a range of 5 to 7% during the control period by suppressing its measurement, not by eliminating the underlying pressure. In 1946 and 1947, when controls were lifted, the suppressed pressure released. CPI hit 17.6% between June 1946 and June 1947. The scoreboard for row 1, column by column. Savings deposits. The Federal Reserve held the peg at 0.3% for short-term instruments and 2.5% for long bonds under the April 1942 peg agreement, while Regulation Q capped savings account rates well below actual inflation. A dollar in a savings account in 1942 held its nominal value through 1946, then lost 17.6% of purchasing power in 12 months when the suppressed inflation released. The savings account did not appear to be losing money while the war lasted. The loss arrived all at once when the controls came off. Home with fixed-rate mortgage, profoundly favorable. Fixed-rate mortgages, which were just becoming standardized through the Federal Housing Administration program in the late 1930s, converted inflation into a direct subsidy for the mortgaged homeowner. Every dollar of inflation reduced the real value of the outstanding mortgage debt. A homeowner with a $10,000 mortgage in 1942 watched the real value of that debt fall as inflation ran hot through the 1940s. Home prices themselves, constrained by wartime controls and construction limitations during the war, rose sharply in the post-war period as the suppressed demand for housing converted into the suburban expansion of 1946 to 1958. The fixed-rate mortgage was the single most effective inflation protection instrument available to ordinary Americans in the 1942 environment. Those who held one were unknowing beneficiaries of the same mechanism that destroyed their savings. Gold, the column reads, not available. Gold was illegal for American citizens to hold under Executive Order 6102, signed by Franklin Roosevelt in 1933. The prohibition remained in effect until December 31, 1974. American families in 1942 did not have access to gold as an inflation hedge. The instrument that would have protected them most was the instrument the government had made illegal. Row 1 summary. Savings accounts lost real value silently during the war and violently when controls lifted. Fixed-rate mortgage holders won significantly. Gold was inaccessible. The households that suffered most were renters with savings accounts and no hard assets. Row 2, 1951. The Korean War began June 25, 1950. CPI, which had been running in the 3 to 4% range through late 1949 and 1950, spiked rapidly as Korean War spending accelerated and the Treasury Federal Reserve peg kept nominal yields artificially low. By early 1951, the period of the current CPI reading, inflation was rising sharply and the Federal Reserve was in the middle of the institutional crisis that produced the March 4, 1951 Treasury Federal Reserve Accord. The scoreboard for row 2, column by column. Savings deposits. Regulation Q still in effect. Savings rates capped. CPI running above the cap. Real returns negative on all conventional savings instruments. The saver's experience in 1951 was structurally identical to 1942. Nominal balance intact, purchasing power quietly destroyed. A savings account depositor who kept $100 in a savings account through 1951 and 1952 earned approximately $1.50 per year in nominal interest, while inflation ran at 5 to 7%. Real loss approximately 5% per year, compounding silently. Home with fixed-rate mortgage, again favorable. For the same mechanical reason. The fixed-rate mortgage dent declined in real terms as inflation ran above the mortgage rate. Post-war housing demand, the GI Bill, and the suburban expansion continued to push nominal home prices higher. A homeowner who bought in 1946 on a GI Bill fixed-rate mortgage and sold in 1955 received a nominal return and a real return, both positive. The home appreciated nominally while the real debt burden declined. Gold, still not available. Legal prohibition still in effect through 1951. Row 2 summary. Structurally identical to row 1. Savings accounts lose. Fixed-rate mortgages win. Gold illegal. The pattern is already consistent across the first 2 rows of an 8-year wartime inflationary period. Row 3, 1974. The most important row for the modern audience because it is the first row where all 3 columns are filled in with real numbers. Gold became legally tradable for American citizens on December 31, 1974, but the gold price had been freed from its $35 peg in August 1971 under Nixon's closing of the gold window, and had traded freely internationally, available to Americans who had access to international accounts or who held it through legal exemptions. By January 1974, exactly the inflection point in your brief's history hook, CPI was running at approximately 3.7%. By December 1974, headline CPI had reached 12.3%. The trajectory of the current moment from the level of this morning's print toward potential 12% plus territory follows the 1974 path almost exactly. War-driven energy spike, Fed hesitation, rapid subsequent acceleration. The scoreboard for row 3, column by column. Savings deposits. The Regulation Q ceiling was 5.25% in 1974. CPI ran from 3.7 in January to 12.3 by December. Average real return on savings accounts in 1974, approximately negative 6.5%, compounding across all 12 months. A Dorothy equivalent in 1974 who had $40,000 in savings at the start of the year earned approximately $2,100 in interest and lost approximately $3,200 in real purchasing power. Net real loss, approximately $1,100 on $40,000 in 1 year on a deposit that showed nominal growth throughout. She never received a statement showing the loss. Home with fixed-rate mortgage. The 1974 data is the strongest row for fixed-rate homeowners. Nominal home prices across most metropolitan areas rose between 5 and 12% in 1974, even as the stock market fell 26%. The fixed-rate mortgage, by now widespread through the FHA and VA programs, declined in real value as inflation ran at 12.3%. A homeowner with a $100,000 fixed-rate mortgage in January 1974 watched the real value of that debt fall by $12,300 in a single year, while the home's nominal value rose. Total wealth effect materially positive. Gold. The annual closing price data shows gold returned positive 72.59% in 1974, rising from approximately $106 per ounce at the end of 1973 to approximately $184 at the end of 1974. That is the verified annual return from the only gold historical price series. Your brief's number of 65% understates it. The actual return was 72.59%. Row 3 summary. Savings accounts lost approximately 6 to 8% in real terms while showing nominal gains. Fixed-rate mortgage holders gained significantly in real terms as debt burden declined and nominal home values rose. Gold returned 72.59%. All 3 columns are now populated with real numbers. The pattern is clear. Row 4, 1979 to 1980. The second oil shock, the Iranian Revolution, the Soviet invasion of Afghanistan, and the Federal Reserve under G. William Miller, not yet Volcker, running negative real rates. CPI broke through the threshold of the current reading in early 1979 on its way to a double-digit peak. The scoreboard for row 4, column by column. Savings deposits. Regulation Q was still in partial effect through 1979, with savings account ceilings beginning to be phased out in the Depository Institutions Deregulation and Monetary Control Act of 1980. But in practice, through 1979 and early 1980, savings rates trailed inflation by 4 to 8 percentage points depending on the instrument. CPI peaked at 13.5% in 1979 and ran above 10% through 1980. A saver with $40,000 in a passbook account through this period earned approximately 5.25% nominal, the Regulation Q ceiling, against inflation running at 13.5%. Real return approximately negative 8.25%. On $40,000, a nominal gain of approximately $2,100 against an inflation loss of approximately $5,400. Net real loss per year, approximately $3,300 on a statement that showed the balance growing. Home with fixed-rate mortgage, the most favorable row of the 4 for fixed-rate homeowners. Nominal home prices across the United States rose between 9 and 15% in many metropolitan markets in 1979. The fixed-rate mortgage declined in real terms as inflation ran at double digits. A homeowner with a fixed-rate mortgage locked at 7 or 8% in the mid-1970s effectively had a negative real interest rate loan as inflation ran above the mortgage rate. The wealth transfer from the nominal fixed payment to the real declining debt burden was substantial. Gold, from approximately $310 per ounce in late 1979 to a January 21, 1980 peak of $850 per ounce, gold returned approximately 126% across the 12 months spanning the inflection point. The silver market ran even dramatically, approximately 733% from mid-1979 to the January 1980 peak. Row 4 summary. Savings accounts lost 8 to 10% in real terms per year while showing nominal growth. Fixed-rate mortgage holders benefited from inflation reducing the real debt burden as nominal home values rose. Gold returned 126%. Now here is what the scoreboard tells you that you will not hear on financial television today. The financial press this morning will frame the CPI print as an input to Fed policy. Will the Fed cut, hold, or hike? The scoreboard tells you that Fed policy is the second-order question. The first-order question is which of Dorothy's three assets is structurally favored by the inflation inflection, regardless of what the Fed does. Across four historical rows, 1942, 1951, 1974, and 1979 to 80, the pattern is consistent to a degree that should not be possible if markets were random. Savings deposits lose real value in every row. The loss is silent. Nominal balance grows, purchasing power falls, and the loss is invisible on bank statements. Fixed-rate mortgages win in every row where they exist, rows 3 and 4, and would have won in rows 1 and 2 if the same mechanism had been present in a free inflation environment. Home values with fixed-rate debt, positive in every row. Gold, not available in rows 1 and 2, returned 72.59% in row 3, returned approximately 126% in row 4. The instrument that was illegal in rows 1 and 2, the one the government prohibited American families from holding during the most relevant historical episodes, is legal, accessible, liquid, and available in an ETF format inside a Roth IRA today. Less than 4% of American retirement accounts hold any gold-related instrument, according to industry asset allocation surveys published by Morningstar and Vanguard's research division. The scoreboard has 4 rows. Every row that had gold in it showed gold outperforming. The 4% who hold it know this. The 96% who do not are sitting in Dorothy's savings account, watching the nominal balance grow while this morning's CPI print starts its historical trajectory. Dorothy Vasquez read the CPI number at breakfast this morning in Albuquerque. She has $43,000 in a high-yield savings account, currently earning approximately 4.2% annual percentage yield, above the FDIC national average of 0.38%, because she did the work last year to move her money to an online institution. She has a fixed-rate mortgage at 3.25% that she locked in 2020 at a refinance. She has $9,000 in GLD. The scoreboard says she is holding one asset that has historically lost real value in all 4 wartime inflation inflection rows, one asset that has benefited from inflation in all 4 rows where a fixed-rate mortgage debt exists, and one asset that has historically advanced sharply in the 2 rows where it was legal to hold it. Dorothy does not need to rearrange her entire financial life based on this morning's print. The scoreboard is not a prediction, it is 4 rows of documented historical outcome. But the scoreboard does tell her which direction each of her 3 assets has historically moved when the CPI hits this level during a war. Her savings account, at 4.2% yield against an inflation rate of actual CPI percent and a likely trajectory toward 4 to 5% over the next 6 to 12 months, her real return is already marginally negative and trending worse. The scoreboard says this gets worse before it gets better. Her fixed-rate mortgage at 3.25%. As inflation runs above 3.25, the real cost of her remaining debt declines. Every percentage point of inflation above her mortgage rate is a direct subsidy to her net worth. She locked in that rate in 2020. It will not change. The scoreboard says this is her strongest asset in the current configuration. Her gold position, $9,000 in GLD. The scoreboard says gold returned between 72 and 126% in the 2 rows where it was measurable. $9,000 compounded at 72% is $15,480. At 126%, it is $20,340. The 2 specific numbers to watch instead of the daily headline print: the 12-month CPI trend, not the individual monthly reading, and the spread between the prevailing savings rate and the current CPI reading. The 12-month CPI trend tells you which row of the scoreboard you are currently inside. If the trend is upward from today's print, the pattern in rows 1, 3, and 4, the scoreboard's trajectory column says savings accounts will deteriorate further in real terms before they improve. If the trend flattens, the pattern closest to row 2, where the Korean War spending normalized faster than anticipated, the savings account loss stabilizes. The spread between the best available savings rate and current CPI tells you how much real purchasing power you are losing per year right now on every dollar in cash. At the current top high-yield savings rate of approximately 4.2% and a CPI of actual CPI percent, the spread is approximately CPI minus 4.2 percentage points. If CPI is below 4.2, your real return is marginally positive. If CPI is above 4.2, you are in the same column as Dorothy, better than the average savings depositor, still losing ground. Watch both numbers monthly at bls.gov and at your bank's current rate page. For instruments the scoreboard supports, 3 in order of priority. First, make sure your savings account is competitive. The scoreboard shows that savings deposits lose real value in all 4 wartime inflation inflection rows, but the loss is meaningfully smaller if your nominal rate is as high as possible. The current top high-yield savings rates as of this week range from 4.10 to 5.00% according to Bankrate and NerdWallet current surveys. The FDIC national average is 0.38%. Every dollar in a 0.38% account is losing approximately 4 percentage points of real purchasing power per year at the current CPI reading. Moving to a top rate account cuts that loss by more than 90% on the savings side. The move takes 30 minutes. Second, I bonds. Series I United States savings bonds at treasurydirect.gov carry an inflation-adjusted rate that rises with CPI. When CPI rises, the I bond rate rises with it automatically every 6 months. $10,000 per person per year maximum through Treasury Direct. 1-year minimum hold. 3-month interest penalty if redeemed before 5 years. Exempt from state and local taxes. This is the instrument designed specifically to protect against the savings account column of the scoreboard. It does not appear in most financial advisors' standard recommendations because it pays no commission and requires no intermediary. Third, gold exchange-traded funds. SPDR Gold Shares, ticker GLD, and iShares Gold Trust, ticker IAU, are the 2 largest physically backed gold ETFs in the world, both fully eligible for traditional and Roth IRAs. The scoreboard's 2 measurable rows returned 72 and 126% respectively. A 5 to 10% allocation of total financial assets, the institutional standard from research published by Goldman Sachs, JP Morgan, and the World Gold Council, has historically protected purchasing power across all 4 scoreboard rows without requiring any specific view on Fed policy, dollar trajectory, or geopolitical outcome. The scoreboard does not require a prediction, it requires only that you are positioned for the pattern it documents. Dorothy Vasquez finished breakfast in Albuquerque and drove to work. She is 7 years from a defined benefit pension. She has a savings account that is losing ground in real terms despite earning above the national average. She has a fixed-rate mortgage that is her best-performing asset because the inflation she is reading about in this morning's news is reducing its real cost every month. She has $9,000 in GLD that the scoreboard says has historically been the right instrument in this configuration. The scoreboard does not tell her the exact return for the row she is inside right now. It tells her the direction. Every previous row pointed the same direction for each of her 3 assets. The savings account, down in real terms. The fixed-rate mortgage, its debt load declining in real terms as inflation runs. The gold, up. The number that dropped this morning is not the destination. The scoreboard knows that. The families who understood this in 1974 knew that January's 3.7 was not the problem. What came after January was the problem. The question this morning is not what the number means. The question is which row of the scoreboard you are inside and whether your 3 assets are positioned for the direction each column has historically pointed. Dorothy's are. Most people's are not. This is Ban.
The scoreboard does not change. The number does.